When the Fed raises rates, loans become more expensive, slowing spending and cooling inflation. Conversely, cutting rates encourages borrowing and economic growth. Global markets watch these decisions closely because the US dollar is the world's main reserve currency. Changes in Fed policy can affect trade, investment flows, and currency values worldwide. Impact of Fed rate hikes on emerging market economies. When the Fed increases interest rates, emerging markets often face higher borrowing costs. Many countries rely on dollar-denominated debt, so as the dollar strengthens, their repayment burden rises, straining budgets. Rate hikes can reduce foreign investment as investors move funds to the US for better returns. This can slow economic growth, increase unemployment, and create inflation pressures in local economies. Countries with weaker fiscal stability are especially vulnerable. Even stronger emerging markets may see temporary currency depreciation. Businesses, governments, and investors need to adjust strategies quickly, monitoring interest spreads, trade balances, and debt maturity schedules. Currency volatility and capital outflows. Fed actions can trigger currency swings in emerging markets. A higher US interest rate often strengthens the dollar, causing local currencies to weaken sharply. This increases the cost of imported goods and raises inflation. Investors may pull funds from emerging markets, leading to capital outflows, which further weakens currencies and pressures financial systems. Countries dependent on foreign investment may struggle to maintain liquidity, forcing central banks to intervene with interest rate adjustments or reserves. These movements can affect stock markets, bonds, and trade balances, creating uncertainty for businesses and consumers. Debt vulnerabilities in emerging markets. Emerging markets often carry high levels of debt, both domestic and foreign denominated. When the Fed raises rates, the cost of servicing dollar debt rises, putting pressure on governments and companies. Weak fiscal management can lead to budget deficits, currency depreciation, and even defaults. Heavy reliance on short-term borrowing increases exposure to sudden global shocks. Countries with low reserves or unstable economies face the greatest risk. Debt vulnerabilities also affect investor confidence, leading to capital flight and tighter credit conditions. Effective debt management, economic reforms, and foreign exchange strategies are essential to reduce risks. Understanding the link between Fed decisions and debt pressures allows emerging markets to prepare for potential financial stress and maintain economic stability. What investors should watch next? Investors need to track several key indicators to navigate Fed-driven market risks. Interest rate trends, inflation data, and Fed statements provide clues about future moves. Emerging market currencies, bond yields, and stock performance show how economies react to global monetary shifts. Watching capital flows and foreign reserves helps assess potential stress in vulnerable markets. Investors should also consider geopolitical events, trade balances, and debt levels. Diversifying portfolios, hedging currency risk, and monitoring liquidity conditions can protect investments. Understanding these factors enables investors to anticipate market volatility, seize opportunities, and avoid losses. Staying informed is crucial, as a single Fed decision can trigger ripple effects across multiple markets, creating both risks and opportunities worldwide. The Fed's next move will shape the future of emerging markets. Stay informed and prepared. If you found this analysis, the Federal Reserve's next decision could send shockwaves through global markets. Emerging economies, already balancing debt and inflation, may face severe currency devaluations and capital flight. Investors and policymakers are on high alert as one rate change could trigger a cascade of economic challenges that ripple far beyond the US. Understanding the Fed's role and interest rate decisions. The Federal Reserve, also known as Fed, is the central bank of the United States, responsible for managing the country's monetary policy. One of its main tools is setting interest rates, which influences borrowing costs for banks, businesses, and consumers. Useful. Subscribe for more insights on global finance and hit the notification bell to never miss an update.